From tissue and paper towels to Tylenol? Yeah, that's right. Kimberly-Clark is acquiring Kenvue, the maker of Tylenol and Neutrogena, in a $48.7 billion deal. This means the merger combines Kimberly-Clark's classics like Huggies and Kleenex with those iconic consumer health and personal care brands, creating a portfolio that includes 10 brands generating over $1 billion each. Kenvue, which spun off from Johnson & Johnson in 2023, has faced challenges, including management changes and public scrutiny, especially related to health concerns surrounding its products like Tylenol. Under the terms of the deal, Kenvue shareholders will receive $3.50 in cash and 0.14625 shares of Kimberly-Clark for each share they hold, valuing the transaction at about $21 per Kenvue share, a 46% premium over its previous closing price. Kimberly-Clark views the acquisition as a strategic move to expand into higher growth, higher margin markets, particularly in consumer health. Yet the acquisition comes at a time when both companies are facing challenges, such as rising costs, shifting consumer behavior, and regulatory pressures. The deal also reflects a broader trend in the consumer packaged goods industry, where companies are merging to diversify and adapt to changing market dynamics. Similarly, IREN, a company previously focused on Bitcoin mining, has signed a $9.7 billion 5-year GPU cloud services deal with Microsoft. Reflecting the trend of crypto miners pivoting to data center services, especially those related to AI infrastructure, benefiting from the AI boom. At the same time, IREN is capitalizing on its existing infrastructure and energy resources, as it becomes a critical link in the AI value chain, providing high-performance computing quickly. Under the agreement, IREN will provide Microsoft with access to NVIDIA GPUs at its Texas data center to support AI workloads. This deal highlights the shift in the crypto mining industry, as companies like IREN are pivoting from Bitcoin mining. IREN also has a $5.8 billion deal with Dell for GPUs and related equipment. The GPUs will be deployed in phases through 2026 at IREN's Childress, Texas campus, which features liquid-cooled data centers supporting 200 megawatts of IT capacity. Moving ahead, IREN's transformation towards more data center infrastructure will be funded with a mix of cash, customer prepayments, and additional financing. Improved AI infrastructure is likely to benefit services like Figma. It recently acquired Israeli AI startup Weavy for approximately $200 million to integrate advanced AI-driven features into its product suite. This acquisition, alongside Figma's broader focus on AI to enhance design and prototyping workflows, is making its platform more competitive against larger players like Adobe. Figma's integration of AI aims to strengthen its relevance in the crowded design software market by offering AI-powered tools that can improve creative processes and collaboration. The Weavy acquisition is part of Figma's strategy to infuse its ecosystem with generative AI capabilities, including tools for AI-based image and video generation. The Weavy integration will be branded as Figma Weave and provides a node-based system allowing users to generate, remix, and refine images and videos. This makes it easier for designers to experiment and refine their creations. Despite the promising AI tools, Figma faces stiff competition. Adobe is advancing its AI efforts, with AI-driven products contributing to a significant portion of its revenue growth, while Atlassian is adding generative AI features to its collaboration software. Figma's recent partnership with Google Cloud to incorporate Google's AI models into its platform also highlights the growing demand for AI tools in design workflows. This collaboration will allow Figma users to generate and edit images more efficiently and enhance product development speed, possibly resulting in greater attraction and retention if these AI features deliver tangible benefits to customers. Another stock to watch is Microvast, since the market is still buzzing over its new high-performance battery solutions designed for long-duration storage and rapid charging, including the ME6 energy storage system. These products are aimed at large-scale commercial and industrial sectors, addressing growing demand for efficient energy storage and fast-charging capabilities. That being said, Microvast faces ongoing financial challenges, including losses and heavy spending on R&D, which may affect short-term shareholder returns. In October, Microvast raised $125 million through a follow-on equity offering, which, while supporting future growth, also raises concerns about shareholder dilution. However, optimists still see a bright long-term outlook because they anticipate significant revenue growth, with projections for $726.7 million in revenue by 2028, driven by an annual growth rate of nearly 20%. Further charge comes from Microvast's push into advanced lithium iron phosphate technology. On top of that, China's possible new export restrictions on lithium batteries could turn out to be a benefit by pushing consumers to seek alternative suppliers. However, the path to profitability will depend on successful execution in both product development and market adoption, as well as managing financial and geopolitical risks related to reliance on global supply chains. For more on stocks and crypto, follow Ascencore. See you next time.